Ayo, thank you for taking the time out to join us today.
Thanks for having me.
So I've had market watchers come, talking throughout the week, and, we've talked about the negative sentiment that we're still seeing around the market, and looking at some of the best performing stocks year to date and how they've, outperformed the index. And but I'd like to ask you what you're advising, talking to your clients in terms of what they're buying, where we're seeing interest across the sectors.
Yeah, most of, you can't dissociate. I think the first thing is we can't dissociate the market away from what is happening in the economy. So for most clients that we still advise in terms of putting funds into the market, they must be patient in terms of having 1 to 2 years investment horizon. Because most of the stocks that are still for most of the top stock, when we start from the banking sector, especially the tier 1 banks, they still have very strong fundamentals, and you check them in terms of price to book multiple, it's still they are trading at significant discounts. I think it's currently around 0.7 times if you look at the average of the tier 1 banks. But when you look at their results, GT led the PAC published its Q3 unaudited accounts about 2 days ago, and you can see that in terms of top line, was challenging, was down by 3%. But if the profit based on efficiency and some of the lines that were able to gain some form of cost, the bottom line was up 3%. So when you compare it to what we've been seeing, it means that there's some form of slow growth within that space, and that can also be linked to some of the policy pressure that some of the banks are also going through. And when you look at with the fragile growth, economic, in terms of GDP growth that we're seeing, still lagging behind population growth rate. So investors are anticipating slow growth. So when you look at even the consumer goods space, before we go to the consumer goods space, for the banks, with all the regulatory, regulations we've seen around the banks, how worried are investors, at least the ones that you speak to, how worried are they about the earnings forecast for these banks? We may see that, going down, but I don't know to what extent is this worry? No, they are concerned because you also, based on especially the policy for most of the banks to increase their loan to deposit ratio to about 65%. For those banks that could not meet up with that as at September, they were debited for that excess. It means that a certain proportion of their funds have been sterilized at 0%. So when you also add that to the current CRR cash reserve ratio, it means the available funds to the bank for them to be able to create assets has been constrained. So, and there's no magic they can perform if those funds are not available. You get, for instance, just putting into perspective, get 1 billion from a client. At the end of the day, if the CRR is as high as 40%, means you can only create asset or earn income on about 600 million out of that. It means that the total cost to you will be high. So for most of in terms of earnings expectation, and what most equity investors buy is future earnings. So if you are expecting that the future earnings within the banking space would be pressured based on the policy, we had the FX policy, there are a lot of policy going on within that space, and that may impact in terms of their growth going forward. Though based on current levels, so when you compare in terms of their fundamentals and the current prices that most of the banking stocks are trading, it's still very relatively cheap. So what investors are doing is they are still buying, but they are not aggressive. Yesterday, you see GT Bank accounted for close to like 40% of total trades. I mean, investors still see value in this bank.
But is that cherry picking? I mean, perhaps tier 1s versus the tier 2s?
We've been seeing more volumes in the tier 1 banks. Okay. Yeah, because of their current prices. And when you look at in terms of multiples relative to their peers in the SSA region.
But what about the consumer goods space? That's another space we've been watching, but it obviously hasn't done too well this year.
They've not. If you even look at in terms of performance year to date, the consumer goods, it's the worst performing sector. And you look at consumer spending has continued to be challenged. Cost of doing business have been going up. So most of these companies can't pass this cost to the consumers that are still struggling. So as a result, their margin has been thinning out, and demand has also been declining, and you can't raise your prices. So there's a lot of challenges within that space. So, but it's only investors that are willing to, that you can wait for within 2 or 3 years before we can see a rebound, because a lot of the structural issues has to be taken care of, so that in terms of the cost of doing business, for instance, the bearish sector, excise duty that has been introduced that will be graduated, that's as those companies, because of the competition within that space, they are unable to pass it to the consumers. You look at even the industrial goods that we expect that there should be demand for their products. Capital expenditure, yes, we see it budgeted, but the concern every Nigerian is having now is that how will government implement this budget based on the revenue performance in the past years? So even if government cannot meet up with their revenue, then capital expenditure would suffer. The demand, housing deficit, we know it's there, but people that are still, if you are not able to save, you can't even be thinking of having your own house or even investing. So those are some of those challenges that investors are considering. And with the continued pressure, like I said earlier, if you are not able to save, your disposable income is being pressured, you cannot invest, because it's from what you save that you would invest. I'm
just wondering I mean, obviously, it's the patient investors, those with a long-term outlook. I'm just wondering how many of those we have in the market, or is it, because I get a feeling that many of them right now are just like, you know what, I'd rather just go take my cash and put it in government treasury bills.
Yes, but there's some interesting, if you look at in terms of dividend yield has improved because of the lower prices. So if most of these companies can still maintain in terms of their profitability ratio, their payout ratio, if they maintain that, and if they pay that relative to the current price, it means that dividend yield will be even more attractive than what you have in a fixed income space. Those are some of the options that investors are considering. That if I look at the dividend yield, it may be better off. And if perhaps I'm lucky, I get some form of capital appreciation. So looking at it in form of total returns, to me, I may be better off investing in the fixed income market.
Okay, thank you, Ayodeji, for sharing for that insight. Very interesting one there. Thank you.